In this lecture, we're going to continue the discussion on corporate income taxes. This is part 2 of the set of lectures on corporate income taxes. We'll first review the graduated tax structure that's currently in effect in the United States for corporations. We will then define some tax rates that are useful for managerial analysis. And we will look at some special cases for large corporations. Let's recall the graduated tax structure that's currently in effect in the United States. Remember, there are 8 ranges or brackets. The lowest bracket, from 0 to 50,000, is taxed at 15%. Income in the second bracket, from 50 to 75, is taxed at 25%. From 75 to 100,000, the income is taxed at 34%. Then the tax rate goes up to 39%. And then something strange happens. In range 5, instead of increasing, the tax rate drops back to 34%. In range 6, it goes up to 35%. Then it goes up to 38%. And then it drops back a little bit to 35%. That's a bit unusual, and that is a quirk in the U.S. tax law that's been there now for about the last 10 years. Let's review example 1, where we had revenues of $450,000, cash operating expenses consisting of labor, materials, rent, and insurance. Total expenses are $192,000. The operating income is $258,000. The federal income tax on that $258,000 is $83,870 for a profit after tax of $174,130. And the explanation of that tax is that in ranges 1 through 3, the first 3 brackets, the total tax is $22,250. So this $22,250 consists of the 3 components: the 15% tax from 0 to 50,000, the 25% tax from 75 to 100, 50 to 75, and the 34% from 75 to 100%. The amount in range 4, above the cutoff of 100,000, that's the difference between 258 and 100,000, is taxed at 39%. And that gives us a total tax of $83,870 using our formula-based approach. Let's define the average or the effective tax rate to be the tax divided by the taxable income. In our example, that's $83,870 divided by 258, giving us a tax rate of 32.5%. That's an average rate, and that can be useful for comparing different situations. Let's also define the marginal tax rate, indicated by the symbol T, subscripted M, to be the tax on the next dollar of taxable income. In our example, that's 39%, and that happens to be the slope of the graph. If we look at the graph, with federal tax on the vertical axis, taxable income on the horizontal axis, our company finds itself in range 4 between the lower limit of 100,000 and the upper limit of 335,000. The slope in this portion of the graph is 39%. So that's the marginal tax rate. Let's look at example 2. The only difference between example 2 and 1 is the revenue. The revenue here is $10,000 higher. All the expenses are the same. The operating income now is $268,000 instead of $258,000. The federal income tax on that is $87,770 for a total profit of $180,230. That's profit after tax. The explanation, similar to the previous example, is that we have the same $22,250, that's the tax on the first 3 ranges, but now the tax in the 4th range is the difference between $268,000 and $100,000. That's taxed at 39% for a tax of $87,770 using our formula-based approach. So we can use the marginal tax rate to explain the change in profit after tax from example 1 to example 2. We had an additional revenue of $10,000, and that's being taxed at 39%. That leaves 61 cents for every additional dollar of revenue. So that's one way we can use the marginal tax rate for managerial analysis. Let's look at some special cases. In example 3, let's look at a company that has a taxable income of $335,000. That's the lower point of this range, $335,000 to $10 million. So this company is just at the beginning of this particular range. For this special case, for any company that's in this range, we can simplify the tax computation by taking the taxable income and multiplying it by 34%. In this example, $113,900. Let's see why this simpler approach works. Here we have the explanation bracket by bracket. The first 50,000 at 15%, 7,500. The next 25 at 25. The next 25,000 at 34%. And the last amount, 235,000 at 39%, giving us our total tax of $113,900 using the traditional bracket by bracket approach. If we take the $113,900 divided by the taxable income, we get 34%. So then this is an average rate across these four brackets. Remember, this company is at the top end of this bracket and at the bottom end of the next bracket. If we look at the graph, then what's happening is that we have the average rate for this rectangle being 34%. Now remember, we had a slope of 15% in the first range, 25% in the next, 34% and 39%. But the average slope is 34%, and that happens to be equal to the slope in the next range. And that's not coincidence. That's by design. Congressional committees that worked on the most recent versions of the tax law made that happen. And in general, that's not going to happen for a graduated tax structure. Let's look at a different example. Let's say we have an existing operation that's expected to have a taxable income of $335,000. And assume we have a new project that's expected to generate additional taxable income of $120,000. So the income tax for the new project then can be determined by applying 34% to the $120,000, or $40,800. Here we're applying the marginal tax rate because we're in this particular range. Let's look at another special case for large corporations, corporations like General Motors, Ford, Chrysler, Procter & Gamble, all your major companies that are generating hundreds of millions of dollars of taxable income would certainly fall in this range where the taxable income is above 18 1/3 million. And let's look at a company that's at the bottom end of that range, just at the cutoff point to get into that range, with a taxable income of 18 1/3 million. Here again, we can take the simpler approach and compute the tax as 35% of the taxable income, or $6,416,667. Let's see why this simpler approach works in this particular situation. Again, we have our traditional approach. Now we have really four brackets or four ranges represented in this $335,000 income. But we saw in example 3 that that is taxed at an effective rate of 34%. The tax on that was $113,900. The next bracket, $9,665,000, is taxed at 34%. For the $3,286,100 bracket from 10 to 15 million, taxed at 35%, and then from 15 to 18 1/3 million, that's taxed at 38%. That generates a total tax of $6,416,667. So if we take that tax and divide it by the taxable income, that's 18 1/3 million, we get 35%. That's the average rate across those 7 ranges. 4 ranges really represented by this line, and then these 3 additional ranges. Again, if we look at the slope of the graph, what's happening is, you can't see down here, but we really have our 4 ranges down here in this little corner of the graph. The next range has a slope of 34%. Then the slope goes up to 35 and 38. In this larger rectangle here, that includes the lower ranges, the average slope is 35%. And that, again, not by coincidence, but by design, is equal to the marginal rate or the slope beyond that. This is the top end of the range. That's range 8, above 18 1/3 million. So because this average slope is equal to this slope over here, for any company that's operating in this range above 18 1/3 million, we can simply apply the multiplier of 35%. Let's look at another example. Let's say we have an existing operation that's expected to generate a taxable income of 40 million. We have a new project that's generating 3 million additional taxable income. So then we can apply the marginal rate of 35% on the $3 million and get a tax, or an anticipated tax, of $1,050,000. The tax rate works for both negative and positive changes in taxable income. So in example 7, we'll take the same situation where originally we might have a taxable income of $40 million, but now we have additional taxable income that's negative $3 million, in other words, a loss from this particular project. Then the income tax for this new project can be computed algebraically in the same way. But now we have a negative number here that results in a negative tax for this project, in other words, a tax credit. Let's look at the combined situation of federal and state taxes. Let's say the taxable income originally for a company is $25 million, and that would put it in the top range, perhaps. Let's say the tax is 35%, and let's say the state income tax is 6%. Normally, the state tax is a deductible item for federal tax purposes. So the state income tax would be 6% of the $25 million, $1,500,000. Our federal taxable income now, recognizing this new deduction that we had not considered before, becomes $23,500,000, subtracting the $1.5 million from $25 million. The federal tax on that is $8,225,000. That gives us a total income tax of $1.5 million plus $8,225,000, $9,725,000. The combined tax rate then on the original taxable income, 25, is 0.389, or 38.9%. So this is the definition of a combined tax rate. It's the average rate of both federal and state taxes combined on the original taxable income. And in our example, the combined tax rate can be computed in this fashion by taking the 35%, that's the federal marginal tax rate, and then adding on to that the state marginal tax rate, but adjusting that by the federal marginal tax rate. So that's the subtract factor. The entire state tax is not being paid because some of that is now being used as a deduction on the federal tax. So here we have a summary of this lecture. We have reviewed the graduated tax structure, the fact that there are 8 ranges, but that the tax rate does not increase monotonically as might be expected for an industrialized country. It tends to increase, but it jumps around a little bit at the upper end. We reviewed the formula-based approach, which is what most accountants use for computing corporate income taxes. We defined the effective or average tax rate as the tax divided by taxable income, and we defined the marginal tax rate as a tax on the additional dollar of income that a company might have. And we looked at 2 special cases for corporations in the U.S., those in the range of $335,000 to $10 million taxable income, and the very large corporations with a taxable income above $18 1/3 million. And last, we looked at the combined tax rate for large firms that might be paying both a federal and a state tax, or perhaps even a city tax. And we developed a formula method for computing that combined tax rate.